Hello everybody and welcome back to another episode of the Investor Motivation Podcast. You are joined by Amy Lehman and I have with me Robert Gowdy.
G'day, how are you, Alice?
Good, how are you?
Going well, thank you.
Lovely.
What are we chatting about today?
Today we will be talking about some bad habits that investors have that might be making them a little bit less effective than they would like to be.
Right, so these are common mistakes, and this is a blog post we got off AMP from their long-serving old mate Oliver.
I think he's one of their economists there.
Yeah, he was their head economist. Yeah, so Shane Oliver was there for as long as I've been in the industry. He's been at the top of AMP. I think there's a lady there, I forget her name, that has taken over that role.
Yep.
But this guy has been in markets, no doubt, his whole life. So I thought, what better person to go through? Obviously, what he's written on, it was done at this mid-October, so it's all fresh, and it's really based on decades of experience, and I reckon that's worth us going through to understand what he's saying.
Yep, absolutely.
Yeah, so there'll be essentially nine mistakes, 9 bad habits.
Yep.
9 things you probably shouldn't do.
Yep.
if you are a long-term investor.
Yep.
We're not talking about trading. We're talking about a lot of this is investor psychology.
Yeah, try and learn from other people's learnings really, rather than make the mistakes yourselves and go through all that pain.
Yep.
Have a listen to this and hopefully absorb as much as possible and save yourself some pain.
Yep. I can guarantee that a lot of this stuff will be, when markets turn down and are bad, that's when you'll least feel like doing stuff. It won't be hard, it won't be easy to implement because your emotions. So the theory will all make sense to everyone, but implementing when you're emotional is completely a separate issue completely.
Yeah, easier said than done.
Correct.
All right, before we kick into it for too long, on behalf of the Investor Motivation Podcast, we would like to pay our respects to the traditional owners of the land on which we are recording and pay our respects to the elders past, present and emerging.
Beautifully done. Cool.
All right, what's habit number 1 that we need to squish?
So Shane Oliver has, so mistake number 1 is crowd support indicates a sure thing. So, and I can relate this one to what's happening at the moment in the markets.
Yep.
The markets are really buoyant, and I've got a ripping case study that not a client, just overhearing stuff as you chat to people.
Yeah, the fire pit chat.
Yeah, the way people are thinking at the moment, and this is a ripping case study, but let's see what Shane has said about this, and he's used a quote from some pretty special investors, and he's used Warren Buffett as a starting point. And Buffett's quote, and for those that don't know Warren Buffett, he's the world's best investor, most patient investor, CEO of Berkshire Hathaway. He has ran Berkshire Hathaway for over 50 years with his business partner Charlie Munger, who unfortunately passed away, I think it was February this year. But his quote is, and it's probably the most famous quote, "I will tell you how to become rich, and that is, be fearful when others are greedy, and be greedy when others are fearful."
Yep.
So when are people fearful?
When there's bad news on the media, when the markets dip overnight, people get really scared.
Yep.
And if it continues on that downtrend, then people get more scared, and that is that bit of a sheep mentality. If everyone's selling off, I need to be selling off.
Yep.
And that is,
how far can it go down?
Yep.
Can it go to nothing? These are the things that we hear. So Buffett is saying at those times of peak pessimism, when things turn to shit, when the shit hits the fan, all those analogies, that is the time, and that is how you can become rich. And I'd like to add, in respect to Charlie Munger, one of a quote that he had was that the money is made not in the buying and selling, but in the waiting.
Yeah.
And it actually is better than some of Buffett's quotes, I believe, that he's saying that there's 2 parts to that. One is the waiting for those events to happen when markets come down.
Seizing that opportunity.
Seizing the opportunity, so being patient enough to wait, and that's why I said Buffett is the most patient person.
Yep.
He will sit on hundreds of billions of dollars in cash until there's an event that gives the opportunity that's meaningful. So it's waiting for those opportunities, and it's also waiting for businesses to grow, and become better
Yeah.
and bigger over time.
So if you are invested and that downturn happens, yes, if you've got that cash available,
Yes.
that's a great opportunity. But also if you're already holding that business and the business itself hasn't fallen to the floor, it's just the markets as a whole, then you wait and you be patient and you do
Yes.
not sell.
And what's happening right now at the moment, that we're seeing great returns in markets.
Yeah, absolutely.
And markets have gone up. And so Shane Oliver's comments here is it's normal to feel safer in an asset when your friends and neighbours are all doing the same. The media commentary is reinforcing. You're seeing your own superannuation policy and everything looks awesome. Why don't we double down?
Yeah.
Which means you're buying high.
Jump on the bandwagon.
Yeah.
That is a crowd sheep mentality thing that it's just human nature for us to have and want to, fit in with the big group that's at play and
Yeah.
have that same experience. But it is just, keeping in mind, be fearful when others are greedy and greedy when others are fearful.
Yeah, so that's mistake number one. What's mistake number two?
Mistake number 2 is that current returns are a guide to the future.
Okay, and obviously number one and number two relate to each other.
Yes.
Substantially. That when you see a great result, it's your expectation and human nature is that great result will just continue to happen.
Absolutely.
Yeah.
And that stacks up, 25% in the last 12 months? I want to get on that and ride that for the future, but
Yep.
it's absolutely not the case.
So what happens with financial markets, or, share markets? The reason why they're so up and down is because of liquidity. We can be buying and selling on a daily basis, a workday daily basis. So you can be in and out in moments, and it's that liquidity that when something goes wrong, when there's a calamity around the world, whether it's war, it's a crazy election or whatever it is, markets can react instantaneously.
Yeah.
So
Absolutely.
people's fear or greed can be baked in straight away. So as a general rule, and the further a stock market goes up in value, our future expected return goes down.
Yeah. They should show that nearly side by side on all price charts around the world.
Yeah.
That yes, that ride up is huge, but that means, at that index level, the future forecasted returns are low.
And the further a market goes down, the future expected return goes up.
What?
Yeah,
Who
stop
would
it.
have thought?
But again, when you're investing when things are down, you're investing at a stage where your emotions and the psychological side is, it's the time when you will least feel like it. And
Yeah.
that's the really difficult part.
And that emotion can really mute that. When we say what we're saying, and yes, returns go up, that means future returns go down. It's easy to understand when you hear it, but like we said at the start, when you're in that emotion, it's hard to switch that down and listen to that reasoning
Yep.
and not be overcome by emotion.
Now, here's my case study, which I think it's a ripper. So a lady has been invested into the Colonial First State Geared Share Fund.
Yep. Risky.
So that is the Aussie market with a heap of gearing involved. So if you put $1 in, there's $1 that's been borrowed and you've got $2 working for you, one of yours. So the Aussie market's up about 22-23%. It's down a bit today, but that's normal. And so that person with the gearing has probably done around 45%
Yep.
for the last 12 months.
Yep. Which is a double return to whatever the normal is.
Correct.
In that scenario.
Yeah, which is great. There's risk being taken on to achieve that.
Yeah.
So what that person is doing is saying, right, husband, I'm setting up for you right now this exact same fund, and I'm going to roll your money over into here.
Yeah.
And I would bet that at some stage in the next 3 years, I don't know when,
Yeah.
we don't know what's going to happen to markets, when they fall or when they go up, we don't know. But I think at some stage, if they do that, the husband won't be terribly happy.
No, it is a
That
game.
is my guess.
Yeah.
It's a pretty solid yes. So, and that is just, your current returns, are no guide to
No.
future returns. They are a decent guide.
They're a guide in the long term. Though. If you can't be looking at the last 12 months returns and expect that for the next 12 months and vice versa, because that's a forever non-cyclical event. It's just up, up, up. We know that's not the case.
And when we look at the charts and we see that, share markets globally on average is around 10-11% return.
Yep.
it's not a straight line.
Absolutely not.
And obviously at the moment the Nasdaq is up around 45%. So, if the average is 11, that's 45% up. That is 30% down.
Yeah.
3% up, no return, 5% down, and everything in between.
Yeah.
And this is the beauty and also the opportunity of share markets.
Absolutely, it is.
Yeah, that humans are involved in the decision making, so their emotions are at play, and that's where you get the greed and the fear, and that's where the opportunity is, if you're patient enough.
Absolutely right.
So that was that. Yeah, a pretty good, I suppose, real life case study. I hope they don't go through with it.
Yeah, and I've talked about it a million times before, but if anyone wants to see a cool chart, the Vanguard index chart that they release every single year has been released for 30 June 2024, and on that chart it does have those historical returns for all the different share markets and asset classes.
Yes.
And it shows the different times of when the markets crash, who might have been in power at the time, when the recession was. So it has that average, which sounds great, but it doesn't hide those massive dips in the massive recessions that we feel and see.
Yeah. So another question that people might have is to say, well, this is all great, Rob and Amy, but how do we know when the market is overvalued or is cheap? I'll give you two ways you can do that. One is go and have a look at your superannuation fund right now. Has it had a ripping return?
Yeah.
I was just doing some reviews for some clients in net wealth that are growth orientated, 22%. Huge result. That is not all in the market. So that is 12% over the average that I would expect.
Yeah.
The other way you could do it is there's a chap called Professor Robert Shiller. I can't remember what university he's at in the US, but he won a Nobel Economics Prize, and he has the Shiller-Cape ratio. And you can do a search, type in Barclays Cape ratio, and you will find country by country where you can go and look at each country and see valuations, and give you a bit of an indication where the markets sit at the moment. Number 3.
Common mistake number 3 is that experts will tell you what will happen. And this is a little bit contradictory to maybe what some of the things we've said, in that, experts, I would see Warren Buffett as an expert.
Yes.
But I do believe what he says will happen, as in be fearful when others are greedy and greedy when others are fearful. But I think this point is more so around when, maybe less so investors or experts with quotation marks will say, like us potentially, they'll say share markets will crash day. But they don't know that. I think it's about taking things with a grain of salt from everybody. And just not believing what you hear from any one person in particular, absorbing as much information as possible and then making your own decisions.
I think economists, obviously, they are approached constantly for their opinion.
Absolutely.
That's part of their job, to be out in front of their cameras, and getting their opinion out there, which furthers their company's, I suppose, their agenda of being known. It's marketing. So they're paid to have an opinion. And there's been lots of research done on, say they're predicting interest rates or they're predicting currency, and they never get it right.
No.
And I've seen it done in the markets where people have, perhaps once they picked, they picked the GFC. There's not many people that did, but say it came down, they've picked the GFC, they feel great. What those people end up doing is constantly looking for the next downturn. And again, I've got another case study, but I'll say that for a moment. But it's the way that people, the expectation, and this is where I remember seeing people come out after, this is the GFC or after the tech wreck. So the tech wreck was 2000 through to March 2003, and after that it went up, and then GFC. But I remember, the experts saying that during and after the crash, hey, we all better expect much lower returns moving forward. And they were saying that after
massive falls.
After massive falls, it then got sold down too far because people became fearful. And guess what the returns were?
excellent for the next 12 months.
Yeah, and beyond. So I've seen that happen numerous times.
Yeah.
And I think it's sometimes you've got to understand that the further the market goes up, the better you'll feel. But the further it goes up, your future expected return will go down. The average, no doubt, will be if you're just investing to share markets, the average will be wonderful over the rest of your life.
Yeah. With patience.
With patience.
Yeah.
But after a crash, I expect high returns.
Yeah.
After a great bull run, which we've just seen, I expect there will be a correction at some stage. The bit that no one knows, and it doesn't matter what level of the food chain you think you are in terms of expert opinion or economist or stockbroker or financial advisor in small town of Horsham, we don't know. No one knows.
If these people did know, they would be the richest people on the earth, and they wouldn't be spouting what they know. They'd be keeping it to themselves and making quadrillions.
That's the beauty with markets and disclosure. So Berkshire Hathaway, Warren Buffett, we know that he sold down half of his Apple shares, which he had to disclose, which means he's now got $280 billion in cash US ready to go at some stage in the future. And that is a reasonable indication of what he thinks.
Yeah.
Without physically asking the guy.
Yeah, well, the rest of the market's still buying in and jumping on the bandwagon. Warren is selling down, stocking up his cash piles, waiting for that correction that we know essentially is inevitable to happen at some point.
That's right. We don't know when.
No.
So mistake number 4 is shares, as in businesses, can't go up in a recession.
Yeah.
Yeah. Now, I've seen this firsthand. So people are reading the news, everything looks horrible, people are suffering out there in terms of high interest rates, and we've got 2 wars going. So people watch the news, not necessarily their investments. So they watch the news, they hear that globally things are really unsettled, news is all bad, that's why I choose not to watch it, and that people are suffering because of high interest rates. And what's happened to their supers in the last 12 months?
Amazing things.
Huge result, probably gone too far.
Yeah.
So the reason is for that is that share markets are factoring in, bad news. I've always said share markets are 9 to 12 months ahead of what has actually happened. Yeah.
When information becomes publicly available to the regular person, the non-professional investor, it has been priced into the market.
It's already done.
Yeah.
Yep, it is already done.
It's not brand new information to you and everyone in the world at the same time. It's priced in, factored in.
Good. Now, mistake number 5 is letting a strongly held view get in the way. And the quote from Ned Davis, his investment analysis: "The aim is to make money, not to be right." Pretty cool. So it talks about obviously biases and strongly held views of, we're talking about the eventual correction or crash, which will happen, don't know when. But imagine us being completely negative and not investing at all while we wait for that to happen. And that so markets can, we've read the research, stay expensive for a long period of time.
Absolutely.
And become more expensive.
We've been saying for probably the last 6+ months that we're expecting something to change and a fall to happen in the markets. But it has been 6 months. Things can stay heightened for a very long time, and
Yep. And the case study that I've got in that space where people have got some strongly held views is a fund manager that will go unnamed. August last year, they shorted their portfolio, so they protected the whole portfolio.
Yeah.
And I just went and checked out their returns for the last 12 months, and they've underperformed it by 12% on the Aussie market and probably about 20 on their global one for the last 12 months. Because, they had such a strong conviction that things were overpriced. And that was August last year, and this, obviously that's probably 14 months.
Yeah, November now.
Exceptional returns. So,
Yeah, and it probably goes a little bit hand in hand with the prior point that shares can't go up in a recession because, like we're saying, things can stay in a bear market for a very, very long time.
Yep.
much longer than anyone could have expected. So having those views, you know, you may eventually be right, but it is that opportunity cost in the meantime that makes a big difference, especially to those fund managers, and really affects their reputations for a long time.
Absolutely. Now, number 6, Amy.
Looking at your investments too much.
I love this one.
Because I think and you specifically have talked about this a lot in the past.
Yeah, yep.
But looking at your investments far too much is never going to be a good thing especially when it's the whole portfolio and just the overall return.
Yep.
I don't think that's going to be a good thing for anyone ever. Not even Warren Buffett.
And there's some interesting stats around this, and I've definitely quoted this on the podcast before, my cheeky reply to a client, but just looking at historical returns, 60% of the time on a monthly basis, you get a positive return. That's on a monthly basis. On a yearly basis, markets are up 70% of the time. On a daily basis, it's 50-50.
Yeah.
So if you're going to go in and look on a daily basis and keep hitting refresh on your portfolio on an intraday basis, it is serving no purpose. You are barracking for a share price or a portfolio valuation. It'll make you feel okay on the way up and dreadful when it goes down.
Yeah.
Because it'll be low the high watermark.
Absolutely. And there is a stat on that when it's up, you feel, 100% good or something, but when it's down, you feel 300% down.
Yep. And
it's not proportionate to those feelings, how it makes you feel as an emotional person.
Yep. So this is a psychological game.
Yeah.
And the cheeky one, I have quoted before where a client said, Rob, how do we get rid of the volatility? This was after the 18 months of bear market leading up to the great result we've seen in the last 12 months.
Yeah.
This client is feeling good. Rob, how do we get rid of the volatility? And I said, stop looking.
Just close your eyes.
Go and do something you like. Now, mistake number 7 is making investing too complex. This is brilliant stuff, and this is coming from an economist, Shane Oliver. And this is a quote from Warren Buffett. It seems to be perverse human characteristic to make easy things difficult. I see it all the time.
Not just investing, but we seem to do that as humans in general all the time.
Overthink stuff.
Yeah. Overthink, overcomplicate. Yeah.
And the way that I explain investing to clients, what is the share market? Well, it's an auction room for businesses and some of the best businesses in the world. And there will be all the short-term reasons why we don't want to be there, and volatility is part of that. But ultimately, these businesses, and let's use Microsoft for example, there is 221,000 people working within Microsoft, really smart, intelligent people trying to make it better. Better products, better services. If you give them enough time, human endeavour will win.
Absolutely. They're not going to...
So let's not overcomplicate that.
No. It was the same as when COVID hit and share markets around the world collapsed, 27% in Australia. But those...
37.
37%.
Yeah, it was a big ouchie.
That is a big ouchie.
Yep.
But those businesses did not just drop in valuation 37% overnight. There's not a single chance that happened. So, we just pushed...
Driven by emotions.
Absolutely.
Yeah.
But that is us overcomplicating things, not just having logical reasoning to think, oh no, that business is still running. There's still all those people working hard to better their goods and services. It was just scared.
Yep.
Yeah.
And I think I see it in the I suppose I click on enough property spruikers to see what they're doing. And they'll have the cash flow analysis spreadsheet that you can download from these guys for free as they try to sell you a property to get huge commissions. That you're understanding the cash flows and the depreciation and deductibility, rent in, interest out, and all the rest is overcomplicating some stuff.
Yeah, absolutely. Looking for tax deductions in those ways, buying new curtains to make depreciation, and that is so complex and more than I would ever want to wrap my head around. So I won't, and I'll go the easy option and buy businesses.
Yep. But buy the right asset class, which we believe is definitely businesses over property. Number 8.
Too conservative early in life. I think we all know the magic of compound interest and compounding returns. So being the best way to do that is to be invested early on in the right space. So yeah, being too conservative early in life.
So let's think about Australian superannuation system. Once you work, you're going to get 11.5% of your taxable income into your superannuation, and in a year, might be next year, it goes to 12%.
Yeah.
So young people need to be growth orientated. Don't
Absolutely.
be conservative. Don't worry about volatility when you are 26, because you cannot touch your money for 34 years.
No.
That's only when you get to 60, and your generation, Amy, you'll make it to 120.
Yep.
So there's a long runway of time for you to put up with a bit of ebbs and flows.
Exactly right, especially if you're not looking at it every day, which we shouldn't be as young people, because you're right, we can't access it for 40 plus years.
Yep.
I don't care what it does in the meantime, it's going to be invested in the right spots and working as hard as possible.
So, yeah, particularly for superannuation, that is such a long-term investment. It is the rest of our life investment. Do not be too conservative here. And just on compound interest is essentially you earning interest on the interest you earned last year.
Mm-hmm. And then more interest on that interest the next year.
Yeah, and Albert Einstein said that compound interest is the eighth wonder of the world. And he goes, he or she who understands it earns it, and he who doesn't pays it. So we can relate that back to, I suppose, going into debt. For going into debt.
Yeah, for any reason
for
at
any
all.
of it. Yeah.
Absolutely, they're paying interest that is paying the people that have the money in the bank earning the interest.
Yep. So wherever possible, when you use debt, it's going to be for an asset which will appreciate over time. Try to avoid debt for holidays, for consumption, for cars, if you can.
Yeah.
Now, some people say, oh yes, but you get a tax deduction if you have a chattel mortgage on a car. Well, you get a tax deduction on the interest that you're paying. And
So you're spending $1 to save 30 cents.
thank you very much, Amy.
You're welcome.
Now,
Before we do go on,
go.
that point was being invested too conservatively early in life, but I think later in life also applies. It's not restricted to just being invested conservatively early on.
Good point. That if someone comes here aged between 60 and 70 and they're about to retire, they're about to sell a farm or a business or just retire,
Yeah.
that husband and wife, I think, what were the stats that, a couple aged 65, I think there was
The likelihood of one of them making it to their mid-90s.
to their 90s was over 60%.
Yeah, it was something amazing like that.
Yeah, so even when you get to retirement is long.
Absolutely, it is.
And being too conservative is a risk.
Yep. They say if you're invested too conservatively, you want to die quick because you're not going to have the money to last.
Fair Peter Thornhill quote on that one. But that's next, I think.
Get out of my head, Peter.
But that's something you need to understand. What is your investment time frame? A lot of people think about my investment time frame is when I retire. It's not that. It's your life expectancy.
Yep.
Money has to last, so you need to make sure that it can grow.
Yeah.
Last one, mistake number 9.
For those non-podcast watchers on YouTube, I've got a crystal ball in front of me. Mistake number 9 is trying to time the market.
Are we guilty of this, Amy?
Potentially at times. I don't think we time the market. We suspect things will happen. We don't know when, but we strategise for that time to happen.
Cool. All right. We have
no.
Well,
is the short answer.
Yeah. Probably at the moment where we are holding some cash back for clients, we know we're getting 5% on a term deposit. That's a pretty healthy risk-free rate of return.
Exactly right. And we're not going to go 100% all in when the market drops 20%. We might go, half in or whatever the proportion might be, but we're not pretending like that's the bottom of the market. I'm going to time it perfectly and go all in there.
And thanks to Amy, we have a very set process to deal with that. We know what we're going to do when the markets get to a certain level.
Yeah.
So there is a quote from a famous fund manager, Peter Lynch, and his quote is, "Far more money has been lost by investors in preparing for corrections or anticipating corrections than has been lost in the corrections themselves." So he's talking about the opportunity cost where people are just so negative for such a long period of time.
Yeah.
And I think it's worth noting that we've taken opportunities as we've seen investments come down. We've been doing some lovely cherry picking where there might be a bit of a downturn in a particular stock.
Yep.
We've been there and topping up. So we are not sitting on our hands and still looking for opportunities. Fantastic. So that's a lot to think about. It's a lot of mistakes. Did you find something else interesting?
Mistakes. Oh, there's some good stats everywhere, but I probably need a webinar for some of these and show everybody these graphs that we can see.
Yep, no worries. Fantastic. Well, thank you, Amy. Appreciate everyone joining us. If anyone's got any topics you'd like us to cover, please let us know. You can go through many different avenues to send us some information. So a comment on YouTube. You are available on
Instagram
and TikTok under the Wealth Diaries. Rob Gowdy on TikTok and Instagram, and please check out our YouTube channel if you want to physically see us, if you need to do that. Not always highly recommended. So our podcast obviously is video there as well, but you can leave a comment there as well.
And I'm a little bit excited to say that we have had a few requests come in, and there is a little bit of a stockpile we have of podcasts that we really want to do. So please let us know what you want to hear still, and we will eventually get there.
Fantastic.
It's nice to have people commenting and giving us advice.
Awesome. So thanks very much, and we'll see you next week. Cheers.
Bye for now.
See ya.